My name is Scott Friede. I am the Division Director for InsurBanc. We're excited to present the state of the insurance industry to discuss AI and how the changing P&C markets have an impact on agency valuation and the M&A marketplace. We will also be discussing what your independent agency can do to navigate and benefit from the changes of the current market. I'd like to introduce our speaker today, Harrison Brooks. Harrison is a partner with Reagan Consulting. He's been working at Reagan Consulting for over 11 years, has experience with mergers and acquisitions, agency valuations, and strategic consulting projects. And with that said, Harrison, take it away.
Awesome. All right. Well, it's great to be here. Scott, thanks for having me. And thanks for joining everybody. So looking forward to the conversation, and I'll walk through the slides here in just a second. And what we had talked about is we'll have time at the end of the presentation just to go over any questions that anyone has. So please feel free to type in those questions, and we will get to those at the end, and we can read those out. And we are really looking forward to the conversation. And it's, I will tell you, I've been at Reagan. I'm a partner of the firm. I've been here for over 10 years. And this has probably been the most change that I have seen in our industry over the past 10 years, has been in the past 4 months. So 2026 is off to a blistering start. I would say it's filled with different storylines and headlines that we will jump into today, but just at a high level, remain incredibly bullish on the independent insurance agent distribution channel, our industry, and we have proven time and time again as an industry to be resilient, and I think that's what we will do in the face of a soft market, AI and technology disruption and change, and you go down the list, continued M&A consolidation, but it's a vibrant industry. So I hope you leave here today encouraged and educated on where the future is headed. Not that I have all the answers, but hopefully it facilitates conversation and deep thought. So let's dive in. So this is a picture of Atlanta, Georgia, on a bright sunny day at Piedmont Park. So it's about 5 miles away from our office here in Buckhead. And I would say this is a picture of what the insurance distribution industry looked like about 5 years ago. Double-digit organic growth, a rising kind of hard market. So you had nice tailwinds at your back, no clouds in the sky in terms of ChatGPT or OpenAI disrupting a portion of your business. Life was good. Valuations were at all-time high. If you're an agency owner, your cell phone was probably ringing all the time for someone to buy your agency at an extremely high revenue multiple. And you couldn't even think about clouds on the horizon. Well, today there's clouds. If I showed you the same picture today, it's not storming. It's not. There's no hurricanes, but there's some clouds in the sky. The sky's a little bit gray, and you're wondering, like, is a storm coming or is this just passing by? And that's what it feels like right now in the marketplace. And so anytime that's in effect, there's opportunity. And so the hope here today is to talk about where that opportunity lies. So the state of our industry, amidst that intense consolidation, continued technological advances, and changing macroeconomic conditions, our industry has never been, stronger than it is today, and the privately held broker is as valuable as it ever has been. That is, if you're doing the right things and you're growing your business in the right way, you have good organic growth, you have talent, you're leaning forward on the front edge of technology to be an early adopter. You don't have to build it, but is your staff and your team willing to lean in and leverage that? So if you look back over the past, we've shown this chart, even over the past, 20 years, I could show this graphic, 30 years, I could show this graphic. But just looking at the past, since really 2020, right before COVID, right when COVID started, this bar chart is organic growth. And our industry has continued to go through COVID. And the EBITDA margins have continued to expand. We've seen a recent pullback in profitability of agents and brokers, a slight dip in profitability, and a gradual decline over the past, really, if you look at since over the past year, a decline in the organic growth rates of brokers. So at the high point of 2023, we saw double-digit organic growth. And now we're looking at something that could dip below 7% organic growth. Historically, though, if you think about our industry and we go back 20, 30 years, brokers typically grow on average 4 to 6%. So we're still above industry average, which what this signals to me in a softening P&C environment, I would bet that that organic growth is going to continue to go down. Meaning, I don't think this is going to reverse trend and we're going to tick back up and brokers will be at 10% organic growth next year. I think we have some headwinds in the rate environment. I don't think that this decline in organic growth rate is from AI or technology disruption. It's through growth rate. And when the growth rate slows, your expenses don't slow down. Your payroll still wants to have a raise. Cost of living increases. So that's why you see the profit pulling back. But throughout the global pandemic, inflation, now we have the tariff concerns and war with the Iran war. You can see brokers are still growing through all of those scenarios. What you do not see on this graph is negative growth. So very bullish on the industry, but I do think there's continued headwinds ahead of us. So how do when we have that growth pressure, what's it coming from? Well, we saw the downward trend in organic growth. This is the privately held brokers are in the dark blue. The public brokers are in the light blue. The public brokers are 4.8%. They typically lead the private brokers in terms of where we're headed. So, my bet again would be that we would see something closer to 5 or 6% organic growth on average. That does not mean don't have clients that are growing at 15% a year organically right now, and they're having some of the best performance years of their company. That is happening, and that is definitely possible if you put the right things in place. But it's driven by growth pressure and the impact of rate and exposure. Trevor Baldwin on a recent earnings call said that it's a meaningful headwind, almost contributing to 6% impact on their organic growth. So if this wasn't here, they're in the mid-single digits. If it wasn't here, they would be at a double-digit organic growth growing firm. And so that's the largest driver, because if you think about your typical insurance agency, 60% of their revenues, 60 to 70% of their revenues is for property and casualty insurance. So if you think about the growth equation, really, what is organic growth made up of? You hear people talk about that all the time. What's it made up of? Because we have to know the components to then know how to influence a strategic increase in direction in the business. So the first thing is just new business production, right? You've got new business production, which is the thing you can control. Rate change, exposure change, and then lost business. You can control new business and you can kind of control lost business, but rate and exposure are out of your hands. It's like the weather. You wake up, it's the same for everybody. So in your firm, if you have a culture of talking about, well, we're growing at 6% this year, and you immediately go to rate and exposure and complaining about the direction of the organic growth of your business, time out, pause, redirect the conversation with your leadership team to focus on new business production and focus on how you can improve retention. And the single biggest way to move the needle is new business production. So that's sales velocity. That's a metric we track and created at Reagan, which is your new business production as a percentage of your prior year commissions and fees. So that metric, new to base. So if you're a $10 million revenue agency and you wrote $1.5 million of new commissions and fees, you'd have a 15% sales velocity. That's your goal, 15% sales velocity. That's what you want to have happen. Because if you have a 15% sales velocity, and let's say you have a 95% revenue retention, that means you're going to grow at double digits, right? 15 minus 5, you lost. Assuming rate and exposure are the same, that's 10% double-digit organic growth. Second observation right now, investors send warning signs, meaning the public brokers, they're down to 4.8% at the end of the year in terms of organic growth. That had an impact on valuations. If you're most of these public brokers, you woke up at the end of 2025 and you were worth less than you were in 2024. Congratulations, you worked an entire year and you grew your business and it's worth less. That's a little bit deflating, and that's a little bit dramatic because marginally it's not that different in value. You're still talking about $1 billion of market cap. But that is the reality when investors reset their projection models to go from double-digit organic growth to single-digit organic growth. And so that has ramifications on our industry because public brokers are trailing the performance of the Standard & Poor's 500. So when we trail the S&P 500, You'd be better off buying an index fund than investing in public brokers. I think that's a moment in time. If you take this same graph and you chart it back historically, public brokers have outperformed the market. And I think we will outperform the market and more consistently as we look at the next 10 to 20 years. But that's and history has proven that. But that's not to say it'll happen in the future. But that would be my prediction. And you can see how they impacted this. Well, why? What caused this decline? Was it just rate and exposure? Well, you had Liberation Day in April of 25, Q2 earnings releases when they announced softening kind of organic growth, and then Q3 earnings releases when they announced softening organic growth again. And so that's where we are. That's what's led to the decline in these growth rates of these businesses. And then if you fast forward to the public brokers multiples at the end of 25, they're 14 times. If I were to update this graph to Q3, they're probably trading between 12 to 13 times EBITDA. So if you think about that, that's down from your historical highs of 18 times EBITDA. So this has implications on the private markets. Not to say that that's going to push down valuations. If the public brokers are valued at 14 times or 12 times, right, and they can't afford to necessarily pay more than that if they're buying your firm. So that could have a downstream effect on agency valuations. However, valuations are based on profitability. These publicly traded brokers, they have a lot of synergies. They have a lot of ways to grow the profit and revenue of a business they acquire. They probably have better carrier contracts, right? And so they're able to justify some higher valuations. There's still 50 plus buyers out there. There's still plenty of demand. So that is what's leading to the valuations holding. But there is a flight to quality and size. Meaning investors right now, they want to buy middle market, commercial, or benefits operations. If it's just personal lines business, some, not all, buyers are more hesitant to buy that because of the threat of AI disruption in the industry. So if you're a 100% personal lines agency, most likely, if you try to sell your business today, unless it has an outsized growth, organic growth profile, or EBITDA profitability profile, you will not be able to sell your business for as much money as you sold your business for last year. Because there is the future threat of, will people procure insurance through ChatGPT and will not need the independent agent or broker? Now, I think we can all recognize on this call that there are significant roadblocks and moats for making that happen, right? We live in a regulated industry. Also, the demographics of people purchasing. Will people want to talk to a human being? Those are all the things that come into equation. So a lot of the market's reaction with technology disrupting businesses, I think, is largely overblown. Does not mean that there's not credibility. So some people point to these concerns as saying, well, this has caused M&A's activity, deal volume to drop. This is the number of reported transactions in a given year. In 2025, we have 470 reported transactions. And you look at different sources, you can see different numbers. But what's a large thing that's been happening here is that investors are not announcing all of their transactions for fear of firms coming in and swooping in and trying to recruit and take away their people. So if you're in the M&A game, people are not announcing transactions as much. If your firm is buying a smaller firm, you might not want to press release that. Because what if a firm tries to come and call on your people or try to hire your producers away, right? When you combine two firms, that's when a firm is typically the most vulnerable because folks are concerned about the unknown. 95% of the time it works out great and people are happy and life is good and the business is growing. But there is a dynamic where why kind of bring attention? Maybe wait a little bit for a press release or don't do a press release at all. But amongst all that noise, M&A pricing remains strong. So the graph I'm putting on the screen shows valuation multiples by size of agency. So the smaller firms, less than $3 million in revenue, right now are trading for under 10 times EBITDA, your profit, which if you think about that, that's a little over 3 times revenue on an average or median basis if you're less than $3 million in revenue, assuming like a 30% profit margin on the business. As firms get larger, they get more valuable. So firms that are over $20 million, which is the top line, are still trading close to 15 times their annual profit. So if you think about that, that's north of basically 4 to 5 times revenue for the business, which is where it sits if it's a larger organization. You have to have the right fundamentals, growing organically, et cetera. a good team. But this is largely driven more so than anything because of supply and demand. You'll see a lot of, articles out there of 30,000 plus agents and brokers, which I believe is correct, but a lot of those firms are smaller. They're not necessarily firms of significant size and scale. So even if you have over $3 million in revenue, you're in rare air. You're in thin air from a size of your firm. So they're based on just supply and demand. There's safety in that. And there's opportunity in that as you continue to grow. But that doesn't mean that the next observation is competitive threats are not accelerating. New strategies are needed to retain and motivate talent. At the end of the day, if we're in a softening rate environment, right, and there's that pressure against you, you've got to find ways to organically grow your business. You have more competitors today than you likely did of size and scale than you did 5 years ago, no matter what market you're in. Meaning, take Atlanta. Okay, I went back and looked at back historically when I started at Reagan 10 plus years ago. You didn't have all the big national brands in Atlanta. There were some, the Alphabet House is publicly traded brokers that were here in Atlanta. But over time, for some firms that we've represented in their sale or their partnership with agencies, firms have sold and joined larger organizations. So this is a chart of just what's happened in the Atlanta market. And this could be akin to any major metropolitan market in the U.S. Over time, larger firms have bought smaller firms and entered these markets and have invested resources to grow and compete in those markets, and they're following population growth. And you have larger and more well-resourced competitors than you did 5 to 10 years ago. Some people on this call might argue and say they're not better organizations. And that's not untrue. Some are, some aren't. Some have done a really good job of entering markets, and it's not the same just because of the brand name on the door. Their operation in Atlanta might be worse than their operation in Chicago, right? And so, or in LA or New York, right? So it's different in every market. But the point is, size and scale is not slowing down in our industry. So what do you need to do because of that? If those large firms are there, if you're a privately held, locally owned firm, spreading ownership is the first step. The best way to attract and retain talent is to have your team secured with equity ownership in the business. So spread ownership. Expand the percent of value creation participation in equity-like awards. So a lot of folks extend real equity to their producers, which are typically the most valuable players in the organization because they control revenue. They're attached to a book of business. Many firms are putting in synthetic equity programs or stock appreciation rights or phantom equity, deferred compensation plans for their non-production talent to make them think twice when they get that LinkedIn message or someone offers them a higher cash deal. So locking down your team and helping them think like an owner and participating in the upside of the organization is a big thing. And then the third thing is just being smart. Those are the carrots. The third is the stick. Read your shareholder agreement. Read your employment agreements, check those producer contracts, and make sure that you've got enforceable restrictive covenants or non-solicit agreements, non-piracy agreements in those documents that are market and fair. So, this is a worthwhile exercise of just sitting down and going through those documents. Most firms have non-solicits, some have non-competes. You want to protect your organization. So when we're talking about equity, people always have the question, well, where do you start? If I'm talking about a producer, what book size should I typically offer them equity? Typically around $500,000 is when in revenue is when someone would earn equity or the ability to buy equity in an agency. So that's your starting point. If they have over a $500,000 book, that's typically when they're offered the opportunity to buy equity or get granted equity. How long does it take? The next question is, well, how long does it take for them to get there? Typically about 5 to 7 years is how long it takes for a producer to validate and build a $500,000 plus book of business. So that's a helpful framework. So expanding a percent of value creator participation. So if I look at the best practices firms, there's over 300 in the US of all different sizes, from less than $1 million in revenue to over $1 billion in revenue. 12.5% of employees at best practices firms are equity owners. And then approximately 30% of employees at best practices firms are likely key contributors to your firm's value creation. Can you afford to lose that 18%? That's the question. right now, I would claim that our industry we're under threat for that 18% not being locked down and retained. So that is something to think about. That is there. So you might want to think about expanding those equity or incentive programs to pay more than just cash compensation. So what are some ways to do that? We talked about synthetic equity, having a golden handcuff. Make it flexible and attractive to participants. There's a lot of ways to customize this, right? Depending on the age and stage of your employee population, there's a lot of ways to do it. And it can be very cost efficient for the agency. You get a tax deduction when these things vest. It does not cost you a lot of cash. And think of them as an insurance policy. Your non-compete agreements, we talked about these table stakes. If they have a shareholder agreement and they're an owner, they typically have a 2-year non-solicit, but you can get a non-compete for those that are direct equity owners, which is something to think about because those are more enforceable from a court perspective. And I said I was going to hold questions till the end, but I did have someone that just typed in a question, so I'll just address it right now in real time. With personal lines agencies being under threat of AI, what are they trading at with buyers? Good question. So we talked about those valuation multiples on the prior page. And I would say for personal lines agencies, if you're just average organic growth, decent profit margins, and you're not going along, I mean, you're struggling to get a double-digit EBITDA multiple. So it's a win if you're probably trading for over 3 times revenue right now in the market. That being said, I've got some personal lines agency clients that are dynamic and they have standardized their systems. They have a pipeline to acquire other firms, to merge with other firms. They're leveraging AI in their systems and their technology to accelerate their revenue per employee, to operate more efficiently. Those, we're not seeing a decline in the purchase price multiple. You can still get a good purchase price multiple for those businesses. There's just fewer people willing to buy them. So it just makes my job harder if I'm helping a firm and I'm representing them in their sale. You just have to talk to more folks because it's not that you can't get the value. You just have to talk to a lot more people. And that's really that dynamic we sit in right now in this marketplace I don't think we've seen necessarily significant value compression, maybe 1 to 2 turns of EBITDA, maybe, but it's more a dynamic of it's either a binary action for the institutional investor community, whether they'll invest in it or not. So there's a jump ball in the air right now, and either someone's going to be right and they will have made the right move of not investing in personal lines because it just gets disrupted, or others have a terrific, massive buying opportunity where they can get market share and volume. One person's fears was their opportunity. So that's where we sit in the market right now. But I do think we have to think about how we operate our businesses and do that more efficiently and look different than we did. If you're going to remain privately held and continue to compete, you have to lean in on the technology side. You have to be thinking about the tools that are available to you, many of which that are off the shelf, to improve the performance of your agency, and the customer experience has to be different than what it was even a year ago, 2 years ago. And if it's not, you really have to look at yourself in the mirror and say, hey, is this sustainable? Can I continue to operate this in a world that's evolving and customers are getting less patient, wanting answers more quickly, and it's all at their fingertips, right? So those are some of the dynamics. And take one more, I'll pause this and we'll keep moving. Search engine optimization. It used to be you advertise on Google, right? Well, now it's not Google as much as it is advertising within and getting yourself to be approved by OpenAI and Anthropic to be able to basically be an approved vendor inside of AI, right? You have to get your kind of application approved inside of ChatGPT or Claude or whatever it might be, to when someone types in what's the best place to buy home insurance in Atlanta, Georgia, who's the best insurance agent or broker, you want your name to pop up. What are you doing to optimize your website, to optimize everything digitally in your online presence to make sure your name pops up? So I think it's actually an opportunity to increase new business production and sales velocity if you're willing to make the investment and do it. So time will tell, though, on that front. So brokers that emphasize technology will separate from the pack. Look, here are the numbers, right? Percent of best practice firms who invested in AI. This is a wake-up call, shot across the bow. For firms that are less than $1.25 million in revenue, so smaller firms, only 11% said they made investments in AI in 2025. Okay, 11, 1 in 10. Okay, the larger brokers that are over $100 million in revenue, 84% said that they made investments in AI. This needs to be 84 to 100% across the board for our distribution channel, the independent agent and broker, to continue to thrive. Agents powered by technology is a winning and dynamic combination. Agents not powered by technology and doing things the same way we've done for the past 5 years is a losing proposition. And so that's my encouragement to all of my clients as we talk about it. Those are conversations we're having all the time. What are you doing? How are you doing it? Where are you seeing success? How are you getting more efficient? And that's to win in this marketplace. I fundamentally believe over the next 5 to 10 years, this is going to be a core component of that success. We just look at producer production. We partner with Broker Tech Ventures. It's a group of firms that are over $40 million in revenue, larger firms, and ask them. 9 firms of that size or greater to identify for their young producers under the age of 35. Identify your top tech-enabled producers and your non-tech-enabled producers, meaning those producers that were leveraging technology in the sales process. They said 82% of their producers under the age of 35 were tech-enabled. And then we asked about the statistics of those, the new business production. The median book size was $384,000 for those producers under the age of 35 versus $216,000 for those non-tech-enabled producers, right? They're writing $170,000 of new business a year for those under 35 that are tech-enabled. Non-tech-enabled is $100,000, $104,000. That compounded over the next 5, 10, 15, 20 years of those producers' careers will make a fundamental difference on what that agency looks like. So my question is to my clients is, are you training on this? When your new producers start, and we've got interns sitting right outside of my office and new analysts that are coming in and joining our team, and we're training on AI and technology and how to leverage and incorporate that into our workflows, making sure our data is clean. You go down the list, that's going to have implications to how you can do more with fewer people and drive up your profitability over time. Does not happen overnight, but there are hard numbers on the producers. And these are things like prospecting before going to an appointment. Have you researched the company, right? Are you able to service more efficiently, right, for your team to get responses back quicker? So those are all the things to be thinking about. But if you're going to go on this AI journey, okay, you have to have clean data, right? People start with the endpoint, the cool looking solution, the vendor sells you something. If your data is a mess in Applied or Vertafore and it's not cleaned up, you're wasting your time. You're not going to get good success. So start with cleaning your data. And then it's data governance, making sure that you've got good safeguards on your data. Like, it would terrify me, massive E&O exposure, if your producers or your service staff are dumping in client policy forms into ChatGPT to ask questions. I would hope that you've got an enterprise-wide account that's in a closed and safe environment to where those questions are being asked. If not, it's a big red flag. Big E&O exposures as your client's public information is then in public domain. So something to think about and train on from an employee standpoint, making sure, and this is not crazy expensive, making sure that it's within the walls of your organization, all of these tools that employees are using. And then change management, making sure someone on your team is leading this initiative. You have to have kind of leadership and ownership of this, someone that's beating the drum, that's passionate about it, an early adopter inside your organization. This does not have to be, depending if you're $1 million revenue shop, a $500,000 revenue shop, this does not mean you go hire somebody. This might be a service staff member who is a little bit younger or just loves doing it. They might be an older person that just really enjoys learning about technology. And are you equipping, empowering them, sending them to the right conferences, right? And encouraging continuing education, just like we do on the insurance side, but on the technology side. So the best firms have adapted to be better and compete with scale. In a consolidating market, right? The big continue to get bigger. They do. But to be small and nimble and specialized, like that wins. That can compete against size and scale in this marketplace. I believe this year, the next 5 years, the next 10 years, the next 20 years. I don't believe you have to be a billion-dollar broker to be successful. I think you can do that if you're focused on the right things. So how do you punch above your weight? Specialization, team selling, the collective power of the organization, engaging with technology and leveraging AI, looking at your firm compared to other firms, benchmarking yourselves against your peers, and then ultimately not forgetting about the relationship dynamic, the centers of influences, right? Connecting with people, right? At the end of the day, someone has a claim. Who do they want to reach out to? They want to reach out to AI, that bot, or are they trusting their agent or broker more than they are the machine? As long as there's still trust in people powered by technology over just the technology, then our segment is vibrant. It's continued growth. You're more valuable than you ever have been. But that is a key component, is relationships, and will always be that. A changing market will emphasize the importance of a true sales culture. So we talked about sales velocity. Here are some specific numbers. Industry average, 11%. Remember, sales velocity, new business production to base. You were at $1.5 million of revenue. You're $10 million. You're $10 million in revenue last year. That's a 15% sales velocity. That's top quartile. That's the gold standard. That's where you want to be. 11% is average. If you're below that, that is going to have some compounding significant effects on your business. You likely are just growing because of rate and exposure. Remember that formula on organic growth, rate and exposure. You don't want to grow that way. It's fine if you do. It's not bad, but you want to focus on new business production and improving your retention. So if you do that, how do you move the sales velocity up, right? Specialization and producer recruiting will win the day. Firms that are specialized have a 12.7%. They have 12.7% organic growth versus those that had 9.5%. And this was from a prior best practice study at the end of 23 when we ran this stat. We could do the same cut today. So 33% higher organic growth for firms that are specialized. Expand that on an individual basis. A commercial lines producer, greater than 50% specialization, over $180,000 in new a year versus $140,000. Average book of business is larger, 1.3 million as opposed to $1 million. And this is for firms that are over $10 million in revenue. Okay, specialization delivers. The producer value proposition. If you want to grow your sales velocity in this environment, you have to put more competitors on the field. Let that sink in. In a declining rate environment, if you want to increase your organic growth, you need more people out there selling. It's not rocket science, right? You got to put more players on the field. To do that, you have to have a winning formula. That winning formula, as we've talked to clients and we see and we witness, it's the power of the brand and the platform, right? How does that producer not feel like they're just a 1099 out there on their own? Do they have the power of the brand and the collective? Does not mean you have to be a publicly traded broker. You could be a niche-focused, well-respected, privately held and locally owned firm and have a power of a brand in a community. The second is compensation. You have to pay at or above market to get the best talent. Doesn't mean you have to be a price leader, but you have to be in line. You have to have wealth creation, meaning it's more than just cash compensation. Some of those things we talked about, right? Those equity incentives, sharing ownership in the company, that's the pathway to create wealth creation. And then freedom from bureaucratic stupidity, right? The red tape that comes with large corporate bureaucratic organizations. At the end of the day, brokers are sales organizations. That's why we're so valuable. We touch the customer, we distribute the product, right? And we're there to provide consultative risk management advice and plan design on the benefit side. And so to do that, where employees are most happy, you don't hear many employees that wake up and say, oh, great, I love the corporate bureaucracy, right? Is your organization, if it's large or small, How do you keep a flat organization? How do you empower the producer? So people ask, well, Harrison, how many producers do I need to hire? What's that look like? Well, I would say rule of thumb, about 15 to 20% of your existing producer force you should be hiring every year. I'll say it again. 15 to 20% of your producer force you should be hiring every year. If you got 10 producers, you should hire 2 this year. Next year, you got 12 producers, right? 20% of that number you should be hiring. You can't hire a decimal point of a person, so the next year you're hiring 3 people. And why so many? Well, 50% of those are likely going to fail. You're going to have to get rid of them because they're not going to be successful. Is that a waste of money? No, absolutely not. The returns are off the chart. Talking 50+% return on a producer if you've got a 50% success rate. The best investment you can possibly make. It costs cash. It does. But from a wealth creation perspective, the value of your agency that you're growing, it's dynamic. So 15 to 20% of your producer force. And ideally, those folks are equipped and empowered with technology. That's going to help them validate faster. It's going to help them write more new business. It's going to help them build a bigger book of business. Incorporate that into your new producer training. Make that a mandatory thing as folks are moving through. The returns associated with owning and operating a privately held brokerage are incredible. Look at the returns over the past since 1990. Pretty big fall off over the past year with the threat of technology disruption, a soft market. There's been a reset, right? Even on our privately held, internally valued brokers, we've had pullback this past year. There's been some headwinds, and there will be some headwinds, but still significantly outpacing the market, right? Think about the market growing at 7% over time, brokers growing at over 9%. The power of that compounded over time is significant, right? So you've all seen the retirement calculators, what this turns into. And so this is a way to invite people on that journey. So in a world where we have threats of technology, in a world where we have a softening rate environment, you don't want to be a sole owner that's rowing the boat upstream by yourself. You want people in the boat with you, rowing against the stream, recognizing we're probably turning a corner, right? And how do you make sure that you're within the best technology moving forward? So those are the things that agents and brokers can do right now to compete. And there's more of a focus than there ever has been to compete at a high level, is that making those investments you need to see the fruit of your labor over the next 5 to 10 years. So I will pause now for questions. I know we went through a lot there and would welcome any questions. You can come off mute. You can type it in the meeting chat. I can jump back anywhere in the presentation that you have. And if you have a specific question for me, as you're typing those in, that's after this and you didn't want to ask the group, you can shoot me an email. It's just harrison@reaganconsulting.com. Happy to chat with you about it. So feel free to send me a note and we can set up some time to chat if you don't want to do that in front of the group. But I'll pause now and open it up to questions. All right, first question. What's the AI effect on revenue per head expected improvement? I don't know. I mean, if you think about it, I mean, I've got the best practices study sitting right here on my desk, and I look at it, and those firms that are growing kind of top quartile are 280,000 or so plus of revenue per employee. Largely over the past 10 years, we've just seen that increase with inflation. So no dramatic shift or change. But I believe over the next 10 years, could it double? Yeah, I think it could double. I mean, you could see something where agents and brokers, $400,000 to $500,000 of revenue is the new normal. So I don't have the answer to that, but I would definitely expect it to outpace inflation. Some of that being driven by technology and some of that being driven by just the average age of service staff and agency owners. So as folks retire, I don't think you have to necessarily backfill someone with as expensive as an employee, or maybe you can outsource a certain function, or your existing employees can take on, you can spread those functions around because they're able to do more with technology. So I'd expect it to increase quicker, but I don't think we're going to see it double over the next 3 years. I don't think it's going to be that quick. I think it's going to be, in 5 years, you're going to start to see some significant difference. And then in 10 years, it's going to be dramatic. Next question. Where can we learn more detail about the different kinds of equity likes awards that we can offer our employees? Good question. Happy to set up some time to talk about that or do an additional webinar conversation around it. We do a lot of work around that. But I would say at a very high level, the things to think about are, do you want them to have real equity and ownership in your company? And that means that a producer or a service staff member is either buying in or getting granted equity, and they're going to get a K1, they're going to get distributions, they're going to be an owner for tax purposes. There's costs to that. There's paperwork to that. There's a lot of legality to that. It's a positive thing. But if you're doing small dollars, I'd encourage folks to look at more synthetic equity type programs, deferred compensation programs. So, as a starting point, like just you can read about it, just type it in Google or even AI or like in Copilot and say, hey, I'm thinking about putting in a deferred compensation program for my employees. What types of programs exist? And it'll give you a few different options, things like stock appreciation rights, options, synthetic equity, phantom equity. So options, they have no value the day they're issued, the right to buy at a certain future price. So you just get the increase in the value of the company. Stock appreciation rights, very similar. You get the increase from this, you set them at a certain point and you get the increase in the value of the company. Synthetic equity and phantom equity, it has a little bit more value the day you give it to an employee. Like you might say, hey, I'm going to give you $10,000 in synthetic equity. That $10,000 grows at the growth rate of the company. So we talked about agents and brokers growing at 9% a year for the past 30 years. That means that 10%, that $10,000 would grow at 9% a year, compounded every single year over time. If you would have put that plan in place in 1990, the one thing to think about, unless it's a profits interest plan, which is only being able to be done in an LLC, those are taxed at ordinary income for the individual. Real ownership is at capital gains. So it's a lower tax rate if someone has real ownership in the company. But the synthetic equity programs, typically employees don't have to pay anything for those. So this is a good thing to do for younger folks, that have small kids or school tuition, or they just bought their first home. They might not have the cash sitting around to go buy stock in the agency. So we see a lot of firms setting up these types of synthetic equity plans as starter equity to get folks going. Maybe it helps with the down payment to buy into the agency. Blaine, good question. Touch again on what sales velocity is. Great question. Because if there's one thing I hope you leave this webinar with today is how you calculate sales velocity. And I hope everyone, that's your core metric that you're tracking for your firm. So here's how you calculate it. It's new to base. How much new written commissions and fees, not bonuses, overrides, or contingents, commissions and fees. How much new written commissions and fees did you do this year versus last year's commissions and fees? So new to base. So I'll go back to my example. You're a $10 million revenue shop at the end of 2025. In 2026, you wrote $1.5 million. 1.5 divided by $10 million of commissions and fees is 15%. That's a 15% sales velocity. If you only wrote $1 million, that's a 10% sales velocity. So it's a way to measure your new business performance. And the reason that matters is we talked about organic growth. That's the single biggest thing you can focus on to improve the organic growth of your agency. So new to base, it tracks new business production. I have some clients that do this even more on a more granular level, and they track this for their producers. So if a producer has $1 million book of business, they say, hey, bud, you better do 150,000 of new this year to keep your 15% sales velocity. So you can get very specific with this to a producer level or even a divisional level that I have folks using this metric. And then let's see, Chris asked, how do you structure an equity offer to a key employee that protects you in the event the employee relationship and performance sours? Great question. So couple ways. I mean, I think sours is some of these awards, they vest over time, right? There's no value until the employee has been there for 5 or 10 years. Okay. So if it's not working out, chances are the relationship's going to sour in the first 5 years. So that's one way of doing it. You can also tie them to restrictive covenants or non-solicit agreements. So if an employee is a bad actor and they violate their non-solicit agreements, they leave the agency, they try to take accounts with them, the value of that equity award, that synthetic equity award, can be zero in how the plan design works. So there's a lot of ways to protect yourself, but the more protections you put in place for the agency, the less valuable it is to the individual, because they say, am I really going to get this? Like, or are you just going to find a way in 9 years and 11 months and 28 days to create a reason to take it away from me? So what assurances do I have that I'm going to have it? So that's why we see firms have some vesting schedules. Maybe it starts after the 5th year and 10% a year of the grant vest each year. So there's ways to do that where it's a balance, right? It's always a risk, but there's also a risk that producer leaves or gets a better deal somewhere else. And so how do you attract and retain that talent? And that's why you want to spread it around. All right, I think I've addressed all the questions. I'll give a moment for any others to come in. And if not, then I think we should be all set. But okay, well, as we wrap up, just want to thank everybody. Like I said, if we can be a resource at Reagan Consulting, just let us know, reach out to me. I'm happy to answer any questions. I know we went through a lot of material today, but what I hope you take away is there's a lot of activity and noise over the past 4 months, but just focus on the fundamentals. Grow your business, lean into technology, invest in growth. What we're feeling in insurance distribution is not dissimilar from every other industry. The business environment right now is going through this across all professional services. Thankfully, we live in a world where we're the fuel to the economy, right? People have to buy insurance. And so how do we continue to make sure that experience is the best possible experience the consumer can have with a trusted partner? So thank you all for the time, and we'll look forward to the next one of these. And thank you, InsurBanc, for putting this together. We really appreciate y'all and your sponsorship of the best practice study. So thanks, y'all.
Thank you, Harrison.